Ladies and gentlemen, on behalf of Captify Consulting Investor Relations team, I welcome you all to the H1FY26 post-earnings conference call of Eleganz Interiors Limited. Today on the call, from the management team we have with us, Mr. Sameer Pakwasa, Managing Director, and Mrs. Archana Desai, Chief Operating Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, a reminder that this call is being recorded. I would now request the management to quickly run us through the investor presentation with business and performance highlights for the period ended September 2025, the growth plan and vision for the coming year, post which we will open the floor for Q&A. Over to you, Sameer.
Hi, good afternoon, good morning, ladies and gentlemen. We'll run you through the presentation. Archana is also with me at the moment. We can continue. So basically, this is the company at a glance. Now, we are into two primary services at the moment. We are doing design and build and general contracting. I will explain them further as we go forward. We are present across 12 states. We have worked in 35 plus cities across the countries. We are spread across the entire Indian region. We've been 37 years in the business now. 26 plus industries, 450 plus clients served, 625 plus projects completed, 30 million square feet successfully executed, and an order book of 5,860 million rupees. Our client repeat rate is about 48.8%, and we have about 400 plus professionals working with us at the moment. Next slide, please. So this is just a few milestones of the company. We were incorporated as a private limited in 96. We entered the southern region, that's Bangalore, basically in 2000. We have opened a woodworking factory in Daisar in 2001. Hyderabad, we started 2008, along with Pune also. 2012, we achieved 200 completed projects. 2016, we expanded the new office in Pune. We became the founding members of IGBC, that's for the Green Building and LEED certified projects in 2018. 2022, we recognized that we started our southern operations and also expanded into Singapore. We converted into a public limited company in 2023. In 24, we had a 7 lakh square feet single project of design and build. It's the largest any contracting firm has still taken till date. We also listed on the NSE in 2025 in February. And the largest order we received also at that time was 188 crores for an airport renovation project. Next slide, please. So basically, the company is governed by three people. That's me, Mayank Sharma, who's the director and CFO now, and Archana Desai, who's the chief operating officer. Next slide, please. So what is design and build services? Basically, design and build services means any client that comes to us, they give us an empty bare shell space. We, from designing to consultancy, to light management, to space management, to IT, to the technology, to the workspace management, cafeteria management, to executing the entire job. Everything is taken under by us under a single roof. We have our own in-house design team. We've just now launched our own design studio at BKC also, dedicated to design, to cater to clients. It's a front-facing office also. We also have our own in-house MEP team that is for mechanical, electrical. They coordinate with all the consultants to get the requirements for the client, whatever the MEP requirements are. And plus we have our execution team also that helps us deliver the design and build services. This is the future. This is where the model is turning. This has been in international markets for years now, and now we are doing this in India very successfully also. Next slide, please. So these are some photographs. This is a project that we did in Bangalore, the 7 lakh square feet that I was mentioning. This was complete design and build done by us, and this was done in a period of 5 months. And there were about 9,000 seats in this facility. Next slide. This is another project which is 2 lakh square feet, again design and built for us. This was done in Mumbai. everything from start to scratch, from UPS to PSC, anything that's required by a client, they issue a single purchase order, and everything that you see in this space is done by us. They only lease the space from the developer, or they have their own property in some cases. Next slide, please. Again, this is another project, 42,000 square feet. Just we can run through these projects now. You can get a brief on our design capabilities. Now, general contracting services is the second service that we provide. In this, the client hires a designer from another firm. Sometimes it could be us on a separate contract, but it could be another firm as a design firm. And then they give the execution to us. In general contracting, they usually can choose the number of packages they give us. They sometimes want to import the modular furniture, carpet, or chairs themselves, but otherwise everything else generally stays in our contract. So this basically again includes your mechanical, electrical, AC, everything that's there that goes into the space, including the finishes, the flooring, the ceiling, the POP, the partitions, the glasses, the toilets, the pantries, plumbing, everything that's included. So then the client gives us a BOQ. We bid as per that BOQ. It is a competitive bid. Tenders are floated in the market, and project is awarded and executed by us. Next slide, please. Again, these are some photographs of some projects that we've done. This is the largest general contracting project that we've done, which is 1.3 million square feet. It's in Bangalore. Next slide. You can run through this. We have our own manufacturing facility. Basically, we do all the woodwork and metalworks at our manufacturing facility in Vasai. This is 27,000 square feet. We at our clients and us, we avoid doing work at site, as much work off site as possible. So basically, even your paneling, if it's polished, if it is required to be storages, everything comes from the factory. Metalwork, all your bases, planter boxes, everything comes from the factory, and they're just installed at site. So you need minimum labor at site, and there's minimum dust and activities happening at site. So we have our own manufacturing facility that caters to these requirements. It helps us in cost efficiency also, plus time management of overall project. Next slide, please. We also have another factory coming up, which we've planned now, which will be coming up in Khopoli in due course of time. That's yet to be shown. So this is a revenue breakup. State-wise, we are right now Karnataka and Maharashtra, Tamil Nadu have been going strong for us. Tamil Nadu, we have a large project right now that is under execution, which the billing will come in the next half. Haryana, Gujarat, all these, even Gujarat, we've just recently picked up a very large order, which we have yesterday only disclosed on NSC. So that will also be coming, the billing for that will be coming in the next half. These are the classes industries that we are under. So you can see that we are across all industries. The breakup of general contracting and design build is also here, and the scope of work also, contractor and subcontractor. Next slide, please. So our order book, I'll give you a little brief on this right now. As on date, our order book, current order book, balance order book stands at 586 crores, excluding GST. That's the net value, which will be the balance sheet value going forward. Our opening order book as of 1st April stood at approximately 350 crores. That included a large order of 160 crores for an airport execution, refurbishment that was there, which is executable over 3 years. Of the balance, most of it has been executed in the first half of 26. Year till date, we have received order inflows to the tune of 346 crores, led by significant new project wins. This has been towards the last quarter of this half, a majority of which are expected to be executed in the balance financial year. We are expected to grow by nearly 3 times heavier on execution on H2 compared to H1, supported by execution timelines. We are aiming to grow at about 15 to 20% this financial year. Whilst our 3 to 5 year CAGR stands at about, commitment stands at about 25 to 30%, stays intact. We're currently in discussion for new orders to the tune of, we are bidding for orders over 4,000 crores with a success rate of about 10% that will come. We've also been awarded recently a project which we uploaded yesterday for about 100 crores. That is also in our current order book, right? We've also inaugurated yesterday, in fact, on Monday, the 3rd of this thing, we inaugurated our design office. This was inaugurated by Mr. Deepak Parekh. He did the ribbon cutting. And that is going to be, as I mentioned earlier, that is going to be a design office, which will focus on design and build, taking that business even further. So this is the project life cycle. So obviously we have a bidding and tendering system. All our corporates issue us a tender, and there's a bid that we go through. Then the project, once it is awarded to us, we initiate the project. There's a whole transition that happens from the tender team to the projects team, procurement team, QS team, who basically handle the project going forward. There's a lot of planning that goes into it, procurement, materials, how the materials will flow in, how the labor force is required to come onto site, and et cetera, et cetera. Design build projects also, what we do is our design team, once the project is awarded to us, they hand over the design to the project team, and then they take it forward from there. Construction, inspection, handover, testing, commissioning, all that falls under the final phases of the project, which followed by billing and payment. Next slide, please. So our average project cycle is about 6 to 12 months. It used to be first 3 to 6 months, but right now our project values and our ticket sizes have gone up. They all, we're doing more and more of the 30, 50, 100 crores now projects. So the average tickets, the time of the projects has gone up by 6 to 12 months. The whole idea of doing larger projects basically is for doing the 100 plus, 50 plus, your competition goes lesser. When you're doing 20, 30 crores, your competition is higher. When you're doing the 5, 10 crore projects, your competition is even larger. There are more players in the market for that. For the 100 plus, there are fewer people, so it is a better edge that we have. Again, this shows us where we are present across the country. These are all the regions that we worked in. We are not really in the east right now, and obviously not Jammu Kashmir side, but otherwise across the country we are comfortably executing projects, and we have teams spread across to execute projects. Next slide, please. This also shows our registered offices. Our strengths, our pan-India presence with global reach. So basically, we're across the country, as I said, plus we've also been doing Singapore. If you see it last year in our console, it also reflects the profits from there. We have got our own factory. We're coming up with a new factory also that will help us to execute our sites even with more this thing. We are also going to start loose furniture over there, which is supporting our clients, which right now currently we're outsourcing. We have a qualified team, experienced team, proven track record. We've already shown that before. And we provide our clients with the green and LEED certifications that are required, because we are part of the Indian IGBC Council, which is which is for the LEED and platinum certifications, LEED, gold, and platinum certifications. Next slide, please. So again, our strengths are we are able to do high value projects. We are able to do client centric approach. We understand our client, what they need, what they want. We are able to execute what they desire. We are expanding to various regions. We can work in 2-tier, 3-tier cities also. Like we've done work in Indore, we've done work in Tirupati, and large scale projects executed over there. High value projects successfully executed and appreciated by our clients. Talent, we are growing our talent. We have good training systems. We have good SOPs in place, and good retention policies also for our talent. And our cash flows are also strengthening with our banking arrangements. Next slide, please. So what do we bring on the table for the clients? Obviously, now we are providing them design and build services successfully, which the clients are really happy with. Our scale also is going up in that. We are also doing turnkey execution, all services under one roof. They don't need to go outside. We don't need to create consortiums or go have partners. We can do everything in-house now. Our regulatory compliances, 37 years history. We've obviously across the city. So if clients have projects coming up in multiple locations, IT companies and they're coming up, so they just need to tie up with us. We can do it's called MSAs, master service agreements for them across the country, for 1 year, 2 years, 3 years also. So back to back, then it's our right of refusal if we want to do the project or not. Our MEP team is in-house. Generally, people don't have that, but we have it in-house, which gives us a stronger edge, gives us better delivery, gives us better cost control for the clients and executing the projects. And again, the sustainability and global standards that we follow. Now, for the investors, we have a diversified model, that's design and build and GC businesses, and the margins will rise going forward. With the strengths that we're able to curate inside, and plus the order size is going up. We have a strong order book, as we mentioned earlier. It's a balance order book of 586 crores. And we have a 4,000 crore current and bidding pipeline that is currently in this thing. And again, the in-house manufacturing and the scale that we're able to. Next slide, please. So all our clients are Fortune 100 of the world. So it could be Fortune 100 of India, Fortune 100 of America, Fortune 100 of the US, but all our clients are the top corporates of the world, from Singaporean companies to all over. And that's what we cater to. If there's any big client, any big corporate coming up with any expansion, our name is generally on the list for the tendering of the project. Next slide, please. So our way forward is we are looking to get into EPC. Right now, we do not do core civil and RCC. We are able to do everything else but that, from the structural glazing to the external development to the landscaping, to chillers, to high side HVAC, high tension power, large panels. What is left in a client is, so we've done a few clients where they've only done the structure and we've done everything else in the campus for them, right? Smaller campuses right now, but yes, everything in the campus for them. Our clients have approached us. If we start RCC, they can give us the entire land with the permissions, with the approvals, and then we can do the entire construction for them with the interiors and everything. So that expands our per project ticket size also. And that's a niche where the clients are not able to find somebody to do the work for them, because if an RCC guy takes the entire job as a lump sum or as a single contract, they're not able to provide the interior finishes that are required. So we've seen that as a gap, and now we are going to focus on how to expand that vertical in-house also. Also, the new factory coming up, which we are now currently, because of the existing board, we are outsourcing quite a bit. The new factory will then have better machinery, more cost optimization, better working methods, and we have the latest technology. Plus, we will be able to do everything in-house going forward. So as we mentioned earlier, our order book is at 586. And we will have a 25 to 30% CAGR growth going forward. And this will be because of the design and build projects plus the scale of the projects that we are executing. Now the 100 plus has already gone up. We've already crossed about 6 or 7 projects in 100 plus. So that is really increasing our capabilities and our footprint across the country. Next slide, please. So these are the performance highlights. The half year is about 111 crores. And previous year, half year was about 200 crores net sales. Sorry. Yeah, H2 and H1. Historically, if you see, we are not a quarter or half year driven company. Our end of the year is usually heavy. I know everyone is doing usually just 1 year data, but if you see our historical data of the last 5 years, which we have obviously with us, it is not a half year company or a quarter driven company. It is the end of the year driven company. So this should not be our the rating system or marking system for us. But yes, these are the numbers that we have achieved for this year and a half year. But as we said, our order book is very strong. It stands at 586 with even if I minus 160 for the airport renovation, we have a very strong order book for the next year, for the balance year to go forward. Next slide. These are some awards and recognitions, and just some awards that we got, best some certificates. That's it. Yeah.
Thank you, sir. Now Anybody wishes to ask the question may use the option of raise hand, and or if you are unable to do that, we'll invite you to ask the question. So we have first question from Rushil Selakra. Rushil, you can go ahead, please.
Hello.
Yeah, hi, Rishi.
Hi, sir. So my question is that wanted to understand about the scope of work. Like basically, like 49% is being done by us and 50% is being given to subcontractor. Is it like that?
No, no, no. So everything is being done by us. That slide that you were seeing is what happens is sometimes large corporates, they instead of giving the contract directly to us, they negotiate with us, but then they put the contract under another arm, right? So there's a client in this one of the top clients of the country, um, Gujarati family, you would know. So they have two arms under them, right? So if we are working for one of their businesses also, they have two arms under them, which basically issue all the contracts. So then we call that under the subcontract model. But again, once it is negotiated by the main client, falls under that, or it comes through an IPC, basically an international IPC, and then basically it comes to our kitty. But then it is executed 100% by us.
Okay. And so for the manufacturing facility, so this flush doors, for press laminates, table storage, everything is being manufactured by us. What is the key raw material required for that?
Plywoods, flush doors, laminates, veneers, fevicol, screws, hardware, metal in certain cases, locks, hinges, all these materials are required by us.
Okay. And so there must be.
MDF is also used. We do not use, the only thing we do not use in a factory and which is banned from being used is particle board. We do not use particle board at all.
Okay. And so whatever thing, let's say if we have to outsource some items, let's say the client is not comfortable with our in-house and he wants to import, so it is being billed by under us, or like we have to do import behalf of them and then we have to like install it, or how does it work?
So what happens is, especially the modular furniture is usually by another manufacturer, and our clientele usually uses the imported brands like Herman Miller, Hayward, Steelcase. Now, these are usually put under our package in some cases not. But there are the dealers or the company representatives over here itself. So we buy it through them. We do not import anything directly.
So these are manufacturing facilities right now completely utilized.
Correct. Right now, we are still outsourcing about 40% of our requirement.
So this Kapoli plant, how much capex we need to require to do, and will it suffice like 100% utilization so that we don't have to outsource?
Correct. It will suffice the 100% utilization. The capex is not worked out yet. We are still under planning stage.
Okay,
But
sir.
it will once the whole idea is that once it is done, we will not need to outsource for the next 5 years at least.
Okay. And so there is no difference in margin, right, between DNB and GCC. If let's say we got a contract of DNB, so there is no like increase in margin, right, compared to GCC work if we do.
Not generally. It's very project. Every project is different. It's not that GC and DNB is different. It's very project sensitive actually. Some GC project can give you a better margin than a DNB. Some DNB can give you a better margin than a GC. Only thing is the industry is moving towards DNB now. The clients don't want two different parties on a single project.
So last question. You said that you bid for the higher projects, higher project value. That the competition is lesser. So like if you can just throw some light at how much extra margin we get when we do a higher value project compared to we do 20-30 crore project where the competition is high.
So we should get about half to 1% extra at least.
Okay, sir. Thank you, sir.
Thank you.
Thank you, Rushil. We'll take the next question from Amit Bhatt. Amit, you can go ahead, please.
Yeah. Am I audible?
Yeah.
Yes, Amit.
Yeah. Actually, sir, most of the regional peers in the same segments, not of your size, but they are operating at a very good profit margin, 10 to 15. I invested in one of the company recently in pre-IPO. So why we are, because we are having our design team, we are having our internal MEP team, and we are having a very good reputation. We are having also the factory for, producing our some of the furniture items. Why we are still stuck at the range of the 5 to 5.5% PAT margin? Because sir, scaling the top line is difficult, particularly in this business. But the low hanging fruit is the bottom line. We can easily improve the bottom line. So because it's not basically a brick and mortar business, like even they are even the facility management companies are giving 4-5% margins. So such a nice company, such a good scale, such a very good team, and very good connections. Why we are stuck at 5.5 to 5.5%?
So what happens, Mr. Amit, is that our clients, the scale that we are working at, they are very well evolved and they are doing multiple projects. They're very well aware of the market also. They give you a basically fair margin of about 15% on the project. They are aware about the cost. Now, 15% according to them is the fair margin is basically profit and overhead. Even if we have any additional items being done on a project, right? There's a lot of change in scope, change in ownership. They give us only 10% profit and overhead. If you remove the overheads from that in the company, administrative costs and this and that, the margin comes down to that. But the money is safe. We don't have bad debts. With these clients, once you sign a contract, the money is 100% safe. When you scale, the margins get thinner. We were also at 30 crores at one point of time. We know the margins are better. But as we are scaling, the margins do get thinner. But the money is safe. That is the difference.
Yeah. So, sir, in the future, can we assume that with the economy of scale and with the backward integration, we can at least achieve 7 to 8% PAT margin?
So we are looking at not this financial year, but next financial year we're looking at some improvement. And once we get into the EPC model, which is again a very slim and thin market, there's nobody there doing the 100-200 crore projects in EPC. There's actually nobody there. If we are able to succeed in that, also definitely, and we will definitely succeed in that. I mean, that's the last vertical left, but definitely we will see it.
And sir, we are basically in the EPCs. That's why we understand the business. So my second question to you, that definitely the synergy between the EPC and you are having this expertise, it creates a very good platform for you. But sir, EPC is something, difficult business to do. So sir, are you going to, start your own team, set up your own, entire setup with the formwork and everything you require, or you tie up with somebody for this sort of projects?
So we are to initially start off with, we want a team that has the expertise in-house, but we will partner with people who will do the work so that at least we have control with the in-house team is able to control it. Going forward, then do we do it in-house or not is still a question mark that we need to, as we grow forward, we will need to see how to go about that. Right now, to start with, we are going to partner with experienced players, but have an in-house team controlling it.
Yeah. And another question is, sir, basically in H1, basically, I understand, and you have to see the entire year profit. It's a lumpy business. But sir, first, in H1, we got only 2% of profit margin. Okay. And what you guided is that you will cover up the, the top line in the coming H2 quarters, and we will have at least 15 to 20%, top line growth. But the bottom line basically in the H1 is crushed to 2% only. So can we safely assume that the entire year result, we can achieve that our original 5 to 5.5% PAT margin?
Yes. So what has happened is in H1 is because the revenue has been lower, the employee cost stays the same. One of the major impacts on the PAT margin. Now that will get averaged off differently as you go forward. It's not that the project individual margins have been impacted.
Okay. Thank you, sir.
Thank you.
Thank you, Amit. Now we'll take the next question from Darshil Zaveri. Darshil, you can go ahead, please.
Hello. Good afternoon, team. Hopefully I'm audible.
Yeah, Darshil.
Yeah.
Hi. Thank you so much for taking my question, sir. So, sir, just like the previous participant asked, we are planning to get to 5% margin. So that would indicate that we would be roughly doing 9% EBITDA. Is that a fair assumption, or how would we look at it, sir?
Yes.
Oh, okay. So H2 will be looking at 9% EBITDA, right? And so just want to know, so to, reach nearly 3x, we'll be executing about 350 crores roughly, the order book. And our order book right now is around 586 crores. And if I see that we have a long-term project which is executed over 3 years, if I remove the portion of that, then our order book will reduce significantly. So what are we seeing that, about order wins? And I know we have a pipeline, but like, what do we see the final order book as?
So right now the order book, as you said, is 586. We remove 160 for the airport. That is a long pipeline project. So I've removed the entire project. Even then I have a 426 left. Now when my current tendering, my bidding is going on at 4,000 crores. That 4,000, we expect a 10% win ratio, at least over the next say 3 months or 4 months going forward. That will get added into this year's order book also.
Correct. So,
And plus there will be obviously then there will be a spillover for next year also.
Yeah. So just want to know, like, most of our order book, we are saying that most of the big orders will get, executed in the next 6 months. That's fair.
Correct.
Okay. And sir, I'm sorry, but I'm a bit new to the company. So we have some loss by JV. So could you just elaborate a bit that? What is that and how do we account for that? And future, is it going to be?
So Singapore, I'll allow Archana to explain this one.
Hello, good afternoon, everyone. Actually, for Singapore, we have already covered the profit last year, basically. And right now, we are not going ahead with any new projects over there. So whatever payouts are there for the consultants, we are doing the payments to them. So that's why it's some nominal losses we have added into this year. Otherwise, it is much difference is not there in the last year and this year.
Okay. Fair enough. I think it's around 80 million, right? It's around
Yes,
8 million, sorry. Yeah, right. 80 lakhs roughly. So that's going to be extinguished in this. That's the final payouts have happened, or anything more
And
liabilities?
basically, the payments has been profits are definitely there, which we have shown last year, and payments have been made from the reserves of the company. So that's why profit has been diluted into losses. That's the reason.
No, ma'am. Like, I think from what I see, H2 last year had like around 1.1 CR of profit, and we've paid out 1.1 CR, and we've paid out 82 lakhs right now. So basically, it nearly is nullifying. So just want to know, okay, is this a recurring item or no? Like, will this be in
No,
H2?
it's not a recurring item. Definitely
Yeah,
not.
so everything is extinguished, right? Like
Yes,
whatever we had.
definitely.
Okay. Fair enough. And just wanted to know like a bit about the competitive intensity. Like, as you're saying that, at the higher projects we go, there is a bit lesser competition. So do we see that, new players are trying to come in, or like, how do we see the landscape out there? What is, if we are tendering for 4,000 crores, that's just us. So what's the market size for us, right? Like, how do we see that?
So as I was explaining earlier, I'll elaborate a little bit on that. For example, currently we are bidding for a project which is also 500 crores. And for that, the market size. Sorry.
Sorry.
So that also, so that market size is now squeezed down to pan India. There are only 3 or 4 players who can bid. The 100 crore projects region wise now, supposing it's a project in Bombay, there are only 3 or 4 players again. But yes, pan India, you will find about 7 or 8 players who can, bid for 100 crores. The minute you go down to 50, there are about 10, 12, 13, 14 players, who can bid for it. The minute you go down to 30, 20, and we are doing a lot of the 30, 20s also, right? Because the order book is so strong. Again, this thing pan India becomes about 20, 25 people. So if I'm bidding for a project in Bangalore, which is about say 20 crores, the client can pull up to in a single region, he can pull up to 7 bids and start competing, and we're cutting each other's throats. Whereas when you go for the 100 plus, the client is able to, like the Bangalore project that we were recently awarded, which we have also uploaded, I think about a month back, the 135 crores gross project. In that, there were only 3 players. The client could not get a 4th player to bid it for it, and could not pre-qualify a 4th player in Bangalore to do it. So the client has a pre-qualification criteria. How much work have you done previously of this scale, this size, GC, DNB, value, They check your financials, they check how much cash flow you have, your CC availability, everything, your because you have to fund the project, right? We are funding our corporates. That is how the business runs. Their payment terms are very different. They want work done, material supplied, installed, then they will take it into billing. Then after 1 month, the certification of bill will happen, and then they'll pay us 45, 60 days, 90 days, depending on client to client payment. So we are funding it. So client goes into a lot of this history, behind what the vendor can be paid, if a vendor can be paid. So that's how the range of brief qualification goes off.
Oh, okay,
I hope
fair
this
enough.
answers.
Yeah, that helps me a lot, sir. So just, in response to this, I just have like, so if there are only three players bidding for that 120 crore project, so do we get better margin than our other normal projects? Like if we are doing around 8%, 9%, so just will we be able to, get that squeeze in that extra 1%, or is it that the three players are everyone is nearly
That's what, yeah,
similar?
the minute, it goes for 100 plus, that half 1%, on that does happen. It does happen. It gives us that difference.
Oh, okay, fair enough, sir. And just a last question from my end, sir. Are we looking to, do some part of like our own branding, in terms of furniture or something that, we want to get into so that we can sell that also to that maybe that has a bit of a higher margin. Just wanted to ask if that's a scope that we've, thought about.
Not at the moment. We've not got any plans of it.
Oh, okay,
We're
fair enough.
strictly a service. Right now, we are focusing completely on service.
Okay, yeah. Thank you so much. Yeah,
Pleasure.
all the best.
Thank you, Darshil. So, sir, we have a question in the chat from Amit Kapoor. Sir, his question is, given the highly promising 435 plus crore order book as reported for December 2024 and the extremely rosy picture shown at the time of IPO, what were the key reasons for such a drastic poor performance of H1 in comparison to not just half on half, but also year on year?
So as I said, we should not be looked at a half-year performance company. Our maximum billing generally happens towards the end of the year. Understand the cycle, if I'll just explain the cycle of our clients. One is, why does our end of the year billing happen heavy is because all the GRNs, they call it GRNs, but for simpler terms, let's call it a budget of a client, right? All their budgets exhaust in March. All the project team, the finance team of a corporate company, they are allocating a budget to the infra team. That infra and projects team has to show that they have exhausted the budget, utilized the budget by the end of March for them to get new budgets in April. Hence, the billing goes very heavy in the last quarter. People are really pushing, and March goes heavy. New budgets that get allocated to for expansions at the corporate level for larger corporates, like companies like us. If we want to make a new office tomorrow, we'll decide, we'll finalize a lease space and move forward. We're not going to budget per se, but they work on a budgeting plan, budgeting format, right? Their budgets, they start aligning April, May, June. They start discussing internal board till the project team gets the budget, till they actually go and lease the space, and then the interior comes out, and basically that order pipeline flows into me. That is the first half which goes in that. So generally the first half is lighter. It is not seasonal, but it is lighter, I would say. People have asked me if it's seasonal, but no, it is lighter. And then that gets executed in the second half. Our spillover of execution in the first half is only what is spilled over from the last year, balance billing, balance projects, balance executions of the last year that goes on, especially for the bigger projects. So, I mean, I wouldn't say right now it's poor performance till the end of the year.
Sir, his next question is, how much of 586 crores of current order book is expected to be delivered in H2 of the current financial?
So we are saying we will forward numbers, huh? 350, about 300 to 350 crores at least. 320 to 350 crores will be delivered.
Okay, his follow-up question is like, not sure I understand how this is different from last year, where first half was almost at par with H2.
So there was one client of last year who had given us the order in sometime in Jan, which was a large client. The order value was 186 crores. That maximum billing happened in the first half.
Okay. And sir, now we'll take the next question from Bimal Panchat. Bimal, you can go ahead.
Hello. Hello.
Yes. Yes,
Yeah,
Mr.
am I audible? Yeah,
Yes.
it's a very good informative presentations about the company. There are no provisions which restricts to disclose the name of a client of whom you received the award. So in fact, disclosing the client from you which you received the award will give a proper, information to the investors. And
So
just to know that we have got based on the L1 we have got at 180. So can you just if you know the L2 figure amount, L2 amount, L2 bidder.
So the answer to your first question is that all our clients, we have very strict NDAs signed with them, and we have, for purposes of IR, for disclosure on NSE, we have taken opinions, and it is we are not still allowed. We have been advised not to disclose the names because of the NDAs signed. All the corporates have these NDAs signed. And it's a standard process. In fact, the very recent client, one of the international top clients of the world, we had an issue because somebody went and said something somewhere, and in a public domain, mentioned the client's name, and the second order from the client we were not able to get. So our business is such that we're signing strict NDAs, and we've been advised by advisors not to even disclose them. Your second question was?
L2 figure.
Generally, so generally,
if you know that.
So the 180 crore project, we were not L1, we were L2, and we were completely given on our capabilities. And what we understand is, what we're not sure, but what we understand is, I think there was about a 3 to 4% difference.
Okay, right. And the post handover, how long is our defects liability period and retention amount in percentage terms?
So it generally ranges from, so the retention amount is generally 5 to 10%, depending on client and their policy structure. And it is generally 1 to 3 years. 3 years is very few clients, but 1 to 2 years is generally across the board. And we release that against bank guarantees.
Hello. Yeah. Okay. That's all from my side.
Okay.
Thanks, Bimal. Sir, we'll take the next question from Raj. Raj, you can go ahead, please.
Hello, am I audible?
Yes, yes, Mr. Raj.
So, sir, what you are saying is in H226, you will be doing around 300 to 350 crores of sales, am I right?
Correct.
So that comes to around, because in FY24, you did around 220, 222 crores of sales. So in FY25, we are expecting around 400 crores of sales, right?
Correct.
All right.
FY?
In FY26, this year.
Correct.
H2 means like,
close 424, 425, 450, yeah.
425, 450 for FY26 closing.
Correct.
The thing is, 1 month back in an analyst call, you said you will be growing 30% very easily. And now in the PPT, you are saying 15 to 20% growth. So I wanted to know, okay, what exactly changed in 1 month's time? So
if we are still saying 30% CAGR will be there, our bidding book has really gone up. Our order book has also gone up. Project initiations from the client end, a few have been delayed. Hence, either the client has awarded the project, or the site is not ready, or like, for example, the airport. Still, it's been such a long time we picked up the order, right? If you've been following us, you know about it. We are still under mock-up. They've chosen a product which is coming from an international country, which was under some design, but they want that product. So the entire space is dependent on that product arrival. So there have been these delays. But now we know how much of that is streamlined. We know how much of that, the work has started, which projects, the towers are ready, what is happening. So we are still saying 30% at a CAGR level is achievable. For this year, we are saying about 15 to 20%.
If you do the math, if you say 300 crores of sales you want to do in H2, so 15 to 20% growth is not right. Then it is 70-80% growth then.
Nirvana?
350, we are saying 111 is already done. Three, but second quarter 350 plus 11 is already done.
Last year was 392, right?
392. So 450, what we're saying, percentage wise, we have to work it out exactly it is coming. But we will do it around 450, definitely that.
You will do
so
around
450.
4
I think you heard. Sorry.
All right.
Yeah.
And sir, about the delays and everything, it happened in H1FY26. So what gives you the confidence to do 300 to 350 crores of sales in H2? Delay can also happen in H2 also, right?
No, so the projects that were awarded closer to in the H1, which were awarded say in the first quarter, they didn't really kickstart. They have kickstarted already in the second quarter and quarter. Now, plus the order book that has gone up in the second quarter. If you've seen online also, we've been uploading the orders. You know the timeline of when these orders have come. All that will go under execution in this half. There may be a little spillover from that also. Plus the new orders will also give us this thing, right? There will be those small 20, 30, 10, 20, 30 crore projects also that keep coming.
Understood. And sir, you just said you wanted to start a new factory. So so exactly how much capex are we intending to do?
So we've not worked that out as yet. We are still working out what sort of machinery, what is the line capacity. There's a whole reverse engineering that happens. A consultant has been hired to do that. They're already on the job to work on it. Accordingly, then the capex will be set. That will be discussed internally, and then it will be set. Right now, we don't have that capex.
And do you also intend to raise any debt or have any funding by?
Not at the moment. Raise any debt for the factory?
Yes.
We have to see. We'll have to see either reserves or debt. We have to still work it out.
All right. All right, sir. Yeah. All the best.
Thank you.
Sir, we have a question on the chat from Piyush Purohit. Sir, his question is, how do we plan to manage H2? Can we get quarter-wise breakdown? Do we expect to close top line at 430 crore while maintaining historical margins?
So yes, as we said, 430 is what we are looking at, 430 to 450. Quarterly, and historical margins, yes. Quarterly, I'll have to revert. We'll have to see if we do it quarter.
Sir, the next follow-up question is from Amit Bhatt. Amit, you can go ahead, please.
Yeah, am I audible?
Yeah.
Yeah, sir, if you remove this airport project, then our current book to build ratio is close to 1, which makes our top line somewhat vulnerable to lumpiness and the unpredictability, which we have seen in the first quarter. And there is a jittery amongst the investor because of that. What strategy or measures the management implement to mitigate that risk and ensure a more consistent revenue flow going forward?
So right now for this H2, we are confident. One is because the order book that is currently in hand. We have also sat down with our pipeline recently, and we've understood the investors are jittery. Usually, we wouldn't have done this, but yes, we understand the investors are jittery. But we have earmarked a lot of the projects which are quick billing also in that, which are 60-day cycle, 75-day cycle, which we are now focusing on picking up before we will not be on the larger orders and, trying to build the book with that. So we are also focusing on that. So that also gives a nice boost to the overall top line, trying to go higher than what we have promised. Yeah, I hope that answers the question.
And sir, actually, because I'm from Gujarat, so I'm very closely associated with the GIFT City. So there is a huge projects coming up at GIFT City, Ahmedabad. Why our company is not targeting some of the projects? Because very marquee investors. Yeah.
We are doing work there. We are doing work there. We've done some.
Okay.
We are doing some marquee clients over there. Some top names are being done by us. We are doing also in Ahmedabad. There's another big location which is controlled by one family. We are doing large project. What we announced yesterday, there's a large project going on.
Yeah, because basically the Gujarat share in your revenue, when I saw that slide, so I saw that it's only 2.5 or 3%. That's why I just suggested. Sir, can you please elaborate on that airport project? What revenue we booked? Because 150, 180 crores or 170 crores, 3 years. Can you throw some light, sir?
So right now we've not booked any revenue over there. I think it's been only 1 or 2 crores, huh? 1 crore, only 1 crore over there. That too some mock-up material that reached the clients. So it's an entire refurbishment. They're uplifting the entire the specific areas over there. For that, we had done the mock-ups first. So they want to review it. Everyone will come and see it and approve it, make their changes. That has been delayed from their end, so the mock-ups got installed and they wanted something different. So we've only booked 1 crore revenue over there. Once that is approved, which is now going to be done in this thing, then the billing will start. So again, we are not taking that in H2 at all, where we expect something to come in H2, but right now we're understanding the client and the nature of the client and how particular they are of how the space will look eventually. We are still not taking it in H2.
Sir, another question is, I think you're talking about that EPC space where you would like to, go. My suggestion, because I am also from the same line. I constructed many data centers, and I think you're one of the pre-IPO investor, Idris Rajkot wala. He was supplying me, Unitile products for all my data center projects. So, sir, what I personally feel, why? Because we are having expertise. Why we are not venturing in the clean room and the data center projects? Because
we are doing clean rooms. We are doing
data center. Why we are not targeting, sir? Infrastructure of data center. It's a big business, sir.
We have. So I'll tell you what happens is in data center, because you're aware, it'll be easy to explain to you. We've done Nextra and all also. We've done Control S Nextra. The problem is that the larger data centers, they're looking for MEP heavy vendors. So their CNI portion is very less. They're doing the building. The fire doors is done by that person. Unitile gets a direct order already. Baki, they are looking for people like Electromech, Listen Lights.
Sorry to interrupt, sir. Actually, we have done at least 18 data centers. We have also done in Mumbai, the Majgaon Dock data center, ONGC. So basically, your company, I'm 100% sure, if your company target public sectors and the government data centers, you will definitely get. Because we are your fire doors we are getting from the Godrej, all this Unitile providing us then precision air condition from the Emerson, and all this the CCTV and all these things we can easily and you are having expertise on that. Most of the big corporate projects which you are doing, 80% things they are coming. So my profit margin in data center is 25 to 30% that I'm talking about. That's why I'm telling you that if there is a even small portion, 50-60 crores with 25%, it will change the entire landscape. Just my suggestion, sir, as an investor.
No. So we have a data center profile also, which you keep pitching to all the data center companies, STT, Nextra, and we've started little.
No, sir, but you directly send your people to the public sector.
Government we haven't done.
Yeah,
government
because,
we
sir,
usually avoid, but we'll look at us.
Sir, every public sector I'm talking, because I have done for ONGC, GSPC, GNFC. So, sir, if you directly approach them, they will give you direct contract for the infrastructure. And the data center part, TCS or Infosys or a Wipro are doing, main thing.
Understood.
So that is another thing which you can explore. And sir, yes. last thing, sir, co-working spaces, this company raised big money from the capital market recently. So if we tie up with any of that player, then we can reduce that lumpiness in our business. So can we do that?
So we've done WeWorks, we are doing co-works. We've done over 1 million for WeWorks square feet already delivered. I mean, I'm not supposed to take names, sorry. But we are doing a lot of co-working spaces. The A-grade co-working spaces, they're tying up with us and they're taking our support for execution.
Yeah, nice talking, sir. And you really deserve a much better, valuation than the some, SME companies. So please, sir, create a good value for the investor. And I think you have a great future. And that's why we are investing. All the best.
Thank you. Thank you.
Thank you, Amit. Sir, we'll take the next question from Keshav Gar. Keshav, you can go.
Hello, am I audible? Yes, sir. Am I audible?
Yes, sir. Please go ahead.
Yes, sir. Thank you so much for taking my question. So, sir, my question is, So, Samir, please pardon my ignorance. I'm new to the company, so I'm trying to understand that once we get the order, if you could take us through the working capital cycle. So, firstly, is the revenue booked on project completion method, or once we complete the project and deliver it, then we get lump sum payment, or it's a milestone based payment? So, for example, if we are executing one single project worth 100 crore, so if you could take us that how much working capital it would require us to put, and is there any retention money ones and so on. So I hope you get the gist of my
I
question.
understood. I'll explain to you the entire cycle of a project. So basically, supposing we, as you said, we'll do it on a 100 crore project or 100 rupee project for that. Let's just say 100 rupees. Usually the clients have payment terms of only 5 to 10% advance against a bank guarantee. So what we do is we give the bank guarantee, we take the advance, but we need about 40% working capital of that project value in our hand to execute the project, because all the long lead items, so basically your chillers, your AHUs, your modular furniture, your carpet, your chairs, which are going to take 6 8 weeks to come, and we have to pay the advances to these vendors and block their this thing. And these are all OEM related materials. So OEM related materials, they have their own policies, they have their own structure in place where they take only advance and work. They don't work on credit terms. Some of them agree to LC, most of them take advance and work. So we need that capital in hand. Now, in the meantime, what happens is on site, there's a lot of activity like your partitions and glass partitions and other activities, civil, flooring, tiles, and all that happens. All these are milestone-based payments. So the material has to reach site. Say, for example, one item, a tile flooring. Okay, tiles have to reach site. The sand cement has to reach site. The labor has to reach site. They have to install it, complete that scope, and only then a running bill is raised for that. So then there is a running bill cycle that comes. Now, till the time the first running bill is raised, is about usually 45 to 60 days. You are able to show work, delivered material and work. 60 days, then they take time to certify that bill. They always, generally the clients have an IPC that does the certification for them, or a consultant that does the certification. An IPC is an international property consultant, basically, your big names, international names who are, do property transaction, facility management and project management for them. Once that certification is done, then the client has the payment terms. By the time the project is finished, usually from the client, including advance, we have only about 30 to 40% payment in our hand. Usually, that is the case. We have only about 30 to 40% payment. And then the final bills are raised after everything is complete. Complete certifications are done, multiple layers of checking the client size, because obviously governance is strong for them too. And then the payments are issued as per their own payment cycle. After the project is completed, there is again a bank guarantee given for the retention once the client signs off, the facility is accepted by them. And the retention, as I said, can be 5 to 10% from 1 to 2 years. There are very few clients who do 3 years.
Right. So, Samir, now what is the risk of bad debts or bad receivable or stretched receivable if let's say the customer, or let's say the builders, typically they are short of funds, and if there is some credit crunch at the builders end, then do we get hit typically?
So if you see, we do not, as I mentioned earlier also, that the idea of working with these clients at the thinner margin is because there is no bad debts. These are all top-rated corporates of the world. Once they sign a contract, they don't budge. We do not work with developers per se. We do not work with builders as such. Even if it is a developer, it is an international developer like a Singapore-based firm that's come here, they're doing work, and they're doing execution or whatever. We do not work with Indian family-run per se, developers. If it's a corporate developer, yes. Corporate structure, yes. But otherwise we don't. But most of our work is only corporates directly. And bad debts is, not even, I think, 0.5% of our work.
So, Samir, now if we do 100 crore project, single project, and what I understood that once the project, let's say, is over by 1 year, and we have spent roughly 60 to 70 crore from our own pocket, and thereafter, once the project is completed, then after a year, we'll get the money. So let's say if our interest cost is 10%, so if we are putting 70 crore for 1 year at 10% rate of interest, so 7 crore is our interest cost. And on this 100 crore project, we will earn, let's say, 9 crores at 9% operating margin. So basically, post interest, hardly some 2, 3, 4 crore would be left, depending upon. So, then how does that make sense for us?
So I said 30 to 40% of what we need to invest in the project, not 60 to 70%. But if you see from our even our books, you will be able to see this very clearly. Our money deployed, including our bank and reserves put together, is today giving us a 500 crore, 400, 500 crore revenue. So our reserves and banks and bank guarantees also put together. It is, I think, about 100 odd deployed.
154 is our reserves.
154 is our reserves plus your bank
Bank
43 plus 43 plus your bank guarantees, right? So about 200 250 reserve deployed. So my utilization of CC is only, say, about borrowing is only, well, short term, I'm saying, is only not even about 10% of the entire this year's turnover that will be required.
So, Samir, will we remain debt free now on a net basis? We are debt free as of now. So, with the growth that we are looking at, will we remain debt free or we'll require some working capital?
Short term, as we grow, the short term short term further requirement will be there. You see, from the IPO proceeds, we were debt free. After removing the debt and the CCs that we made zero, we put the balance into an FD, which you can, it's there on the balance sheet also, that 63 in hand. We put everything into an FD that is still parked in an FD. Against that, we take an FD-OD facility. So that is under utilization because we need money to run this thing. If once that FD-OD is completely listening, and the growth goes up, and the order book also goes stronger, orders in hand is stronger. Right, currently I have orders worth of 586 in hand. We will need to go back to CC to fuel the growth.
So, Samir, which are the major competitors that we come across whenever we bid for these projects, and are there any listed ones that you can name?
So none of them are listed, but competitor names I can take, right? So there's ANJ, Padam, Exotic is there, ANJ is there, Padam is there, Ambience is there, Space Matrix, DSP Design, yeah.
So basically, Samir,
DWP Intrix.
So, Samir, I couldn't understand. I saw in the presentation that we are now planning to go the whole hog and start doing the outer shell also, the building part. So, I mean, if we are doing anyway all the interior, then what is the need for us to go and compete with Ahluwalia contracts and with all the risks that come with that? So, I mean, does it really make sense to get into the building part of the structure?
So you took a very good example, Ahluwalia. So what is happening is Ahluwalia is one of the only ones per se who's able to provide the client or customer with that 100 to 200 crore ticket size, which involves the shell and also involves the interior finishes, landscaping, glazing, everything. Now, when it comes down to doing the interiors, where a client of our repute and our stature that we are executing works for, when it comes to doing their interiors, usually they are not able to provide the finesse or finishing that is required, right? The marble, the veneer, the polish, the factory backup, the team, the MEP, the quality that's required. If a project is, say, 100 crores, including interiors, landscaping, and everything which we are helping a client execute, everything is there. The shell component of that is only about, say, 20 crores. The rest of it actually becomes an expertise that is already under my kitty. So for me to compete with an Ahluwalia on a project like that, the client will first come and give me the job because the 80 crores expertise and the finish and the delivery, on-time delivery, giving the client the space and the experience lies with me. There are nobody else doing these 100 L&T and LNW will not touch these projects.
Okay, so last question, Samir. Now, what is the USP that we have? The various names, approximately half a dozen competitors you named. So, where do we score above them, and what is our right to win?
So our main USP is our in-house capabilities, right? After the half a dozen names that I named, There are only one or two that actually have the full-fledged, actually only one that has the full-fledged in-house MEP team from execution, procurement, tendering, designing, everything. It's not that we just have. We are doing also in design today. We have a BIM team that is in-house. We are doing BIM for our clients also, and that is the future. Now AutoCAD is going to be obsolete. I mean, all over the next 10 years, you won't hear about AutoCAD. We are doing that in-house. We are able to do architectural concept drawings in-house. These are our capabilities that stand us apart.
Great, Samit. Thanks.
Thank you.
Thank you, Keshav. Sir, we'll take the last question from the chat. Sir, his question is just wanted to know sector-wise revenue breakdown from FMCG, finance, and etc.
I think it's there on the sheet. If you can please display it. So 20. So you want it for the half or the last year? Shared it. So sector-wise, asset and leasing financing is 22%, real estate and infrastructure is 19%, pharmaceutical and healthcare is 12%, information technology is 12%, finance investment services 10%. Is there enough? No, this is 25, 26, I'm saying half year. Banking financial is 6%, machinery equipment 5%, income components, others is 10%. Yeah.
Okay, sir. Sir, that was the last question for the day. So, do you want to give any closing comment?
No, just that, yes, we are not a half-year company. I mean, I know everyone's reviewing only last year's data, but historically, if somebody has, takes out 5 years data, you will see that the second half, especially the last quarter, is what we are heavy on, and that's where the numbers should be judged. That's about it.
Okay, so thank you to the management. Thank you for the valuable time, and thank you to all the participants for joining on the call. This brings to the end of today's conference calls. You all may disconnect now. Thank you.
Thank you.
Thank you.